I think it's fair to say that global ETFs, or funds that cover a big portion of the stocks around the world, are popular because people view them as having a slice of the world economy. In other words, if the world economy grows, investors in a global fund get some of the benefit of that. That certainly appeals to me, and it's one of the reasons I decided to go for a global fund rather than an S&P 500 fund. But which ETF did I choose? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. Now if you're new, you saw the name of the channel and what gives? This is a dividend channel, why are they talking about index funds? But those who have stuck around for a while will know that I organised all my stock investments into what I call the metronome portfolio. It categorises investments into three sections: the base, dividends and income; the middle, index funds, and that's what this video will be about; and the tip, which covers riskier investments. I'm of the opinion that the middle of the portfolio should be as set and forget as possible, essentially a no-mind aspect of your portfolio, and for that reason I only want one fund in there and I opt for a global fund. I chose FWRG to do that job. Here's the criteria I used to judge it and why I chose it. Investing in a global ETF for your portfolio requires careful consideration of multiple factors to ensure you achieve the best possible long-term returns. Let me just explain my key selection criteria and why the Invesco FTSE All-World UCITS ETF, FWRG, stands out as a strong candidate for investors who have similar logic or requirements as me. Let's take a look. First, geographical coverage. Why it matters. Diversification is a fundamental principle of investing, helping to reduce risk by spreading exposure across different regions. A true global ETF should cover both developed and emerging markets to capture broad economic growth while mitigating localized downturns. The FTSE All-World Index, in this case tracked by FWRG, includes a wide range of large and mid-cap stocks from approximately 50 countries. This means investors gain exposure to high-growth markets like China, India and Brazil, which might be excluded in other ETFs focusing solely on developed economies. Emerging markets often experience higher growth rates than developed ones, and by investing in FWRG you tap into future growth drivers, ensuring your retirement investments benefit from a global economic expansion. A balanced approach is best. So now you might be thinking, if emerging markets are higher growth, why bother with the rest of the global fund? But rather than going all in on emerging markets, I believe a global ETF like FWRG offers the best of both worlds. Exposure to emerging market growth, India, China, Brazil, etc. Stability from developed markets, US, Europe, Japan. And then lower volatility and better risk-adjusted returns over time. Going all in on emerging markets might seem appealing due to their historically higher growth rates, but I think a balanced global approach is more sensible for long-term investing. Emerging markets tend to be more volatile, prone to political instability, currency fluctuations, and weaker financial oversight. During downturns, they often fall harder and take longer to recover. For instance, the MSCI Emerging Markets Index dropped over 50% in the 2008 financial crisis, compared to a 40% decline in the MSCI World Index, and some countries like Brazil and Russia took more than a decade to recover. Another problem with going all in on emerging markets is they often face challenges like higher inflation, liquidity constraints, and restricted capital movement in some regions. Developed economies like the US and Europe still lead in innovation, corporate governance, and economic stability. The S&P 500 alone accounts for 40% of global equity markets, reinforcing its influence. So by investing in a balanced global ETF, investors can capture emerging market growth while minimizing excessive risks, aiming for long-term stability. Secondly, total expense ratio, or TER. What is TER? The total expense ratio represents the annual percentage cost of managing the ETF. It includes administrative fees, management costs, and operational expenses, reducing your net returns over time. With a TER of 0.15%, FWRG is one of the more affordable global ETFs, though the SPDR MSCI ACWI ETF, ticker symbol ACWI, offers an even lower TER of 0.12%. It actually lowered its fees after I'd already chosen FWRG, and I decided to stick with FWRG rather than hopping between any fund that decides to lower its fees. However, FWRG still remains a strong contender due to its accumulating structure and broad market exposure, making it a cost-effective choice for long-term investors. Up to you if you think that's a reasonable justification, or you think I'm just being lazy here and not switching to the lowest fees. The compounding effect of low fees. Assuming a £50,000 investment over 20 years with an 8% annual return, here's how TER impacts the final portfolio value. So with a TER of 0.15%, the final portfolio value after 20 years will be £233,047. With a TER of 0.22%, the final portfolio value will be slightly lower at £227,918. And then a TER of 0.3% will be £222,580. So assuming all else remains equal, lower costs increase your retirement savings over the long term, making FWRG a solid option here. Thirdly, the dividend policy, accumulating versus distributing. ETFs can either distribute dividends, so payouts in cash to investors, and these will have a DIST or DIST at the end of the name. On the other hand, they could accumulate dividends, so reinvest them within the fund, and these will have the ACC or AC at the end of the name. Invesco FTSE All World UCITS ETF, the FWRG, has AC at the end of the name, so FWRG is an accumulating ETF, meaning dividends are automatically reinvested, increasing the share price and maximising long-term growth. Why accumulation works best for what I need? No manual reinvestment required, so it's more aligned with the no-mind approach I mentioned earlier. Dividends compound over time, and more efficient for tax-free accounts like SIP, etc., which is incidentally where I'm holding it. If you are holding outside a tax-advantaged account, then it's a bit more complicated, but I can't talk about that without a ton of different disclaimers, so we'll save that for another video. And by the way, if you're looking for somewhere to buy a global fund like I'm talking about in this video, then this is also where the sponsor of today's video comes in, XTB. With XTB's investment app, you gain access to over 3,600 stocks and ETFs across 14 global markets, including both FTSE 100 and S&P 500. XTB's recent ISA promotion is definitely an eye-catcher, so where most brokers are offering a decreased rate, XTB is offering a boosted 6.5% interest rate on uninvested funds for 90 days, a 2% increase from their standard variable AER of 4.5%. This applies to both new and existing customers, with the promotional period running from the March 1st to April 30th, 2025. The platform offers advanced tools such as detailed stock analysis, live market updates, and educational resources tailored to investors of all levels. Its user-friendly interface simplifies portfolio management, allowing you to reinvest dividends and monitor your financial goals effectively. Additionally, XTB's low transaction fees and commission-free trading on certain accounts make it an attractive choice for cost-conscious investors during uncertain times. If you want to try XTB for yourself, then there's a link to sign up in the description and the pinned comment of this video. Capital at risk. Back to the criteria. Fourth, the replication method, physical versus synthetic. This one's a little abstract but still worth mentioning. If you zone out of this short section, I can completely understand. How ETFs replicate an index. With physical replication, the ETF directly holds the underlying stocks. With synthetic replication, the ETF uses derivatives to mimic index performance. FWRG follows a sampling-based physical replication method, meaning it holds a representative selection of stocks rather than every single company in the FTSE All World Index. So what does that mean for us? Physical ETFs have greater transparency and lower counterparty risk, whereas synthetic ETFs carry risks related to derivative contracts. For what I'm looking for, physical replication is generally preferable due to its reliability and lower risk profile. No need to increase obscure risks for relatively little benefit here. Fifth, fund size and liquidity. A larger fund typically has lower bid-offer spreads, greater liquidity, so it's easier to buy and sell shares, and higher investor confidence. FWRG has an AUM of approximately £764 million, which provides reasonable liquidity and stability, though larger ETFs may offer even narrower bid-offer spreads. I think the largest is likely to be VWRL by Vanguard, but to be honest, I think this would ultimately be probably pretty negligible difference, though happy to be corrected in the comments if you have evidence to the contrary. Sixth, domicile and tax efficiency. Why domicile matters. The country where an ETF is domiciled affects taxation, particularly withholding tax on dividends from US stocks. A tax-efficient domicile ensures that investors retain more of their returns. Comparing Ireland versus Luxembourg for ETF domicile. Ireland domiciled ETFs benefit from a 15% withholding tax from the US stocks due to the US-Ireland tax treaty. This ultimately means investors keep a larger portion of dividends from US stocks. Luxembourg domiciled ETFs, however, are typically subject to a 30% US withholding tax, as Luxembourg lacks a favourable tax treaty with the US. Some Luxembourg ETFs use more complicated tax-efficient structures, but Ireland remains the preferred domicile for tax efficiency. Why this matters for FWRG. FWRG is domiciled in Ireland, meaning it benefits from the lower 15% US withholding tax, making it more tax efficient for holding US stocks within a global portfolio. Over time, these tax savings can significantly improve net returns, especially for long-term investors. 7th, currency exposure. FWRG trades in GBP, eliminating foreign exchange fees when buying through UK platforms. That being said, underlying assets are priced in multiple currencies, so fluctuations in currency will still affect performance. So even though you buy and sell the ETF in pounds, its underlying holdings are in various global currencies like USD, Euros, and Japanese yen. This means that if the pound strengthens against these currencies, the value of those foreign holdings decreases when converted back to pounds, reducing the ETF's performance. Similarly, if the pound weakens, the value of the foreign holdings increases, boosting returns. So you should be aware that while trading in pounds avoids direct FX transaction costs on the platform, currency movements will still play a role in long-term returns. Conclusion: why FWRG is the best ETF for me. With broad global exposure, low costs, tax efficiency, and a structure optimized for long-term growth, FWRG is my top choice for an ETF. While other ETFs may have slightly lower fees, FWRG offers an excellent balance of cost, diversification, and efficiency, making it an ideal investment for long-term retirement savings. Going straight to the lowest costs, or TER, as a strict rule means that you'll always be having to keep up to date with the current fee structures, which takes away from the intention of it being no mind, at least in my opinion. I'm happy with FWRG as the choice for the middle of the metronome section of my portfolio, and don't feel the need to change it. What global fund do you use, or do you prefer to stick with something else like the S&P 500? Let me know in the comments.
If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!